Tax credits are implemented to encourage certain behaviors that we consider to be in the best interest of the country. These tax benefits are aimed at home ownership, education, children, and their caregivers. Tax credits are not deductions from taxable income, but rather credits that can be taken against existing tax liabilities. The taxpayer can claim two types of credits. First, a non-refundable credit can be taken dollar for dollar against an existing tax liability. These credits may reduce the taxpayer's tax liability to zero, but then any excess of non-refundable credits is simply lost. So, if a taxpayer's tax liability is already zero, there is no additional benefit from claiming non-refundable credits, even if the taxpayer is otherwise eligible. Second, refundable credits are those that a taxpayer is entitled to whether or not he has an existing tax liability. In this session, we will discuss the more common non-refundable credits. Most credits are non-refundable. They include child tax credits, child and dependent care credits, and education credits. In Session 6, we will complete our discussion of non-refundable credits by introducing you to some less common but important credits, namely residential energy credits, retirement savers credits, credits for the elderly or the disabled, and other credits. Again, let me repeat the definition to make sure we understand. A non-refundable credit can be applied against an existing tax liability. However, if it exceeds the tax liability, you lose the difference. So, for example, if you have a client that has a tax liability of $2,000 and non-refundable credits that add up to $3,000, then you will reduce his tax liability to zero, but he will lose the benefit of the $1,000 excess non-refundable credit. If, on the other hand, the client were to have $3,000 in refundable credits, he would actually offset all his tax liability and get a $1,000 payback from the IRS. So refundable credits are preferable to non-refundable credits. In any event, we value them both.